Hello and welcome back to another day of charting. My name is Justin and today this video is sponsored by the color red. As you can note here on the heat map for the 1 day, we have red in the trillion-dollar companies like Tesla, Amazon, Facebook, Google, NVDA, Microsoft, and Apple. And on the flip side, we see that healthcare, consumer defensive, REITs, energy, utilities are green. So we are definitely going into a risk-off day, and that is on the back of the FOMC meeting minutes. And there's a few other things we're going to talk about today. DXY is approaching 100. So I think I actually want to start here. The takeaways from the Fed are that they're looking to do two things. So we heard about the top end of the balance sheet runoff being at about 100 billion, and it's only 95. So it's only 95. That is still a lot. 95 times 12 is, how much is that? 12 times 95 is $1.14 trillion per year. And with a balance sheet that is well over 7 trillion, this is going to take an incredibly amount of time to actually run it off. But again, that's the headline. The second headline is that we got 25 to 50 basis points per meeting, TBD. And that TBD means that to be determined. What I believe the Fed is doing is that they're trying to kickstart both programs at the same time and then give the market time to have a feedback loop where they can see, what do we want to have? Meaning, what do we want the treasuries to be at? What do we want the market to be at? What do we want the dollar to be at? And then if we're not getting what we want, we tell the market, like we heard yesterday from these Fed heads. So what's actually more important than what we're doing here is just what happened to SPY today. So looking here at SPY, we got a doji. So the most important thing here is that we're opening and closing at roughly the same price. So we chopped up all day, but opening and closing at about 446.6. So we open at 446.87 and we're closing out at 446.55. So what that tells me is that we are equally bullish and bearish from the time that we opened and we closed. We didn't quite fill the gap, got the 20 DMA. That's about it. Couldn't muster much more and couldn't really get down to the 50 weekly moving average either. We got pretty close, right? Did we actually kiss it? Nope, we were off by about 10 cents. So similar to how we saved 449 before at 449.11, right? What do we got here? 449.14. We saved that 50 weekly moving average here by about 10 cents. So as of right now, that's a save. But what's more important for me is this daily candle here. So let's think about this. We heard from the Fed. They told us that we're basically doing 95% of the worst case scenario for balance sheet runoff. And we're going to be doing 25 to 50 per meeting, TBD. So this 95 in balance sheet runoff actually means there is the equivalent of additional basis points per meeting. So like I said, I believe that what they're planning on doing is to do the 25 per meeting, maybe for the next couple, maybe you get a 51. They want optionality. So this way, if they want to go by 50, the market will no longer be surprised. They want to go to 95 per month and starting in May, the market won't be surprised. And we clearly see that here on the tape by forming that doji pattern. What did QQQ do? I actually don't even know. A little bit more of a spinning top, meaning that we're closing roughly 2 points below where we opened. But in terms of the S&P or the broader market, we have the doji here. So that's the biggest takeaway for me. On the flip side, now let's look at these 10-year bonds. Why? Well, we're within a whisker of getting to a 30-year bull break. We're already poking over. We can note this trend is established going all the way back to 1988, right? When Justin was born, right? There we go. Almost exactly to the month, actually. And now we finally poked above. So every previous time when we hit this downtrend, we reject. Coming up here, reject last month. And then we built up more pressure and released it. We even had to dance with it here on the daily chart. So hit it, back off to the previous top, break out. And now we're actually backtesting, filling the gap. And we only have to rally about an extra 0.5%. So right now, again, just drop the decimal points here. This means that the bull break in a 30-year breakout. On the flip side, too, we also have DXY going in for a win. And as I mentioned yesterday, inverse head and shoulders and W's are some of my favorite patterns. So we cannot ignore this here. Why? One test, two tests. If on the third test it keeps going, it's probably not going to look back. And there are some higher highs for us to get through. If we can break through 100 here, we got up roughly to 120. We also pit stop here at about 110, but those are big numbers. That would add a lot more pressure onto the market. Remembering that what the Fed is looking to do in 1 year is what the ECB is planning to do in basically 2 or 3 years. So what would you rather own in terms of dollars? US dollars or euros? And by the way, there's no war happening in America right now. It's happening in Europe. So this dollar strength is actually a bigger culprit for me than people might think just for the bonds. So looking at the month here on S&P, we're down by about 1.13% here. And in terms of where the dollar is, we're up on the month here by about 1.3. So S&P is still not really all that much changed when we take into account what these things are priced in dollars. So if this thing's going to break out, we've gotten pretty close to 100. 99.77 is the high. If we break above that and get through 100 on a weekly close, I don't see how we're not going to keep going. There's going to be more pressure on tech on everything, and this 10-year note getting so high is going to be a particular pressure point on QQQ. So what does that mean? Well, what's really interesting about where we are in the market right now is that we're baking in about 300 basis points of hiking through 2023, and then we're actually baking in 100 basis points of cuts after that. So right now, this is the first time through a rate hiking cycle, which is starting, that people are actually baking in cuts later. So what does that mean? They're going to front load all these rate rises, all this balance sheet runoff, so they have optionality for later. What are they going to do? They're going to do the 180 pivot again. They're going to go from, oh, well, maybe it is transitory. Maybe we should lower. Maybe we should stop doing as much tightening. Blah, 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 blah. We also heard about those Russian sanctions today, right? European went yesterday, USA today. It's pretty bad. I'm not going to lie. I'd really love for this global peace to start getting resolved. I think everyone would want that. And now we also have the fear of another lockdown, where Fauci is telling us today that cases are going to rise, blah, blah, blah. So the market loves certainty. And right now, things are not very certain. So now we have an understanding of where the market was. What we talked about yesterday was the leaders were still green on the week and still leading. Well, we're going to see that's flipped today. Why? Well, look, they're red. So they're the most red on the 1 day. If we zoom out to the 1 week, we can see that we're mixed, right? It's actually financials which are getting hurt here. And the things that were strong today, like railroads, transportation. We look at the last 1 month. Still pretty clear. There's breadth, there's depth. So if today is a one and done, we should see the true trend emerge tomorrow. That's just my opinion. I think there's a lot for people to digest here. And here's what I noticed for a theme actually today. More important than the Fed is how people were positioned going into this meeting. This is from Monday the 4th, 2 days old. Mike Wilson is the head he's the head over at Morgan Stanley. And again, what is he saying? We are doubling down on defensive because a correction is likely imminent. Bear market rally is setting a stage for a correction, Morgan Stanley Mike Wilson warns. And his playbook here is pretty obvious. We're doubling down on defensive. So we're doubling down on defensive. Growth is becoming the primary concern for equity investors rather than higher rates. And his picks are, healthcare. Where can I find this here? Wilson's market playbook includes utilities, consumer staples, and healthcare. Oh, God. Let's look at that 1 day again here. What do we got? Healthcare, consumer defensives. He's got REITs in there too, and utilities. Utilities, consumer staples, and healthcare. Interesting. I need something below 4,000 to get me really constructive, said Mike Wilson on Jan 24. I do think that'll happen. So the question for us now is, if people were positioned for this going in, actually, I want to brag for a second here too. So let's have a look and see what our end-of-day target on S&P was. So whether or not we get what we want is different than whether or not the market delivers what it's supposed to. So the printed close on SPY today is 446.52. Our guess here was 446.38. Pretty close. It got revised a few times, but what's really important here is that your expectations for the market are not misaligned with what it's able to deliver. So you're like, S&P didn't close low enough. And the bears are like, it didn't close low enough either. So getting what you want and being prepared are two different things. So in my opinion, what I'm noticing here is that let me tell a quick story now. So again, right about 10 minutes, I'm trying to get these videos down to no more than 15. So in about the next 3 minutes here, I'm going to try to explain my story really fast. We heard more negative news overnight, which was, again, Russian sanctions, right? They're going to get completely off of all energy out of Russia, And now we're going after Putin's family. That's pretty bearish. That's a ratcheting up of rhetoric. What happened? We moved overnight. We got a gap down below the 200. We closed below the 200, but we got a doji, which means that the market had a chance to digest the news going into the open. The 445 puts for today did not get printed, and S&P closed flat with rotation. And the reason that matters is because we have indecision as we are approaching what? Strong support. Strong support is found at the 50 weekly moving average, or the short-term price, which is right here at 443.37, our low of the day, 443.47. Saved it by 10 cents. That's enough for me. If this is the low and we're not going to test that 50 DMA, QQQ got close enough to its 50 daily moving average here that I would say that is technically a test. We got down to 350.56, and that is within, I don't know, like 0.25% for us to get down here to about the 50 daily, and we already pushed off the 50 weekly. So in my opinion, if we're going to keep going lower, I want to see more of the same. I want to see more of big tech going lower with the biggest declines. And today's what? It's Wednesday. So pump these babies into Wednesday, fade them into Friday. So that's what I would expect to see if the bears are actually in control and actually going to move us lower. So going back to the S&P now, that's the bear case. So let's go back to our why, bull, and bear, because I want to try to actually tie this all together in a story. So monthly continuation, right? Well, we didn't get that. Let's go back and have a look here now. So now that we understand that on the daily, we're basically unchanged. Now let's look at our higher timeframes here. So on the monthly, what do we get? Well, we have a lower high and a higher low, but we did break below the 44892 level. I was hoping and praying we were going to hold. Didn't quite do it. So we didn't really see monthly continuation. We have monthly consolidation into the seasonally strongest month of the year, which is April. TINA. Well, it looks like there is TINA, but people are not bullish at any price. Bad news versus good news. So we baked all the bad news in. This is the most hawkish we have ever seen the Fed meeting minutes. And when we heard that in December, the market got really surprised. So they overemphasized, over-explained. They were mansplaining why they got a hike. So that's the bull case, the bear case. 454 is an unpenetrable fortress. Well, it's penetrated a few times, right? On the weekly twice, on the monthly here, on the daily. So bulls are not exactly clearly winning. The bears also not clearly winning. The recession risk was kind of shrugged off today. Why? We closed with the doji. Yield curve inversion. Well, George yesterday got us the yield curve inversion uninverted. There we go. Still got surprises. Still got earnings coming up. And that's what we got here. Looking at our base case, TINA, right? There's no alternative to stocks, but not any stocks. So today we see that healthcare, consumer defensives, energy, utilities are hot. And these were before, which just means that there's no alternative to stocks, but it's which stocks are going to be the best ones. 454 pivot. I still think it's a pivot. We still got 2 more days of trading left. Bulls and bears are fighting for direction. Absolutely. I don't know the bulls really have the edge anymore. They should have saved that low. So we didn't, right? New weekly and monthly low, not hot. Got an upper gap to fill. Didn't do that either. And then we got earnings coming up. So, oof, right? A little bit confusing right now. We got through our key date of Wednesday here. And tomorrow we got ECB monetary policy and jobless claims. Before next week, we got the CPI, JP Morgan kicking off earnings on the 13th, OPEX on Thursday. And then we got big tech earnings kicking off on the 19th. There's a lot to go through now. But we've digested all this uncertainty. We still have a bullish pattern. So until proven otherwise, and again, I'm talking about a weekly close below the 50, we have to assume this is bullish. So it's not a perfect head and shoulders either, right? So if this was perfect, we'd have no more than below 44892. Well, we pierced below it. So that's why we have to adjust it here. So we have an inverse head and shoulders. And for us to breach and for the bears to claim victory, all we really have to do is just close the weekly chart below 443,442. I would say there is solid confirmation if we're able to close below the 50-day DMA as well. So if we close below the 50 DMA or get back below 440, right, that would pretty much cinch it for me. We got a death cross here, which is a lagging indicator. We got that bear market rally, like Mike Wilson's talking about. Gap below the 200s. That is going to be the impenetrable fortress now, 44892. Our high of the day, 448.93. So that could also be a rejection off of the monthly low if we don't go higher. And this will get invalidated. And then we have what? Well, we don't have a clear pattern anymore. This will get deleted. Then we opt to being within a range where the red line is resistance. Sorry, the red line is resistance. The green line is support. And we just wait and see what the chart is going to tell us to do. If this is, again, pressure building up, pressure releasing, and now we're getting a reversal, we're back to what? Within a range. Where? Between the white line and the red line. If we fall below the 50 and below the white line, well, now we have this whole big pocket here to deal with. And that means that our quarterly chart is now going to be bearish, and that is not what we want in what is seasonally the strongest month of the year. So with that said, I think I'm going to leave it there. There's not really much for us to go through. I don't want to make this into a 20-minute video. If you have any questions, I highly encourage you to go back and watch the video, which is for the weekend, which is going to come up here in a moment. Thank you again for watching, and I wish you all the best of luck into tomorrow. Thank you.